As markets digest the latest developments in Venezuela, attention is turning to what this means for global oil markets, short, medium, long term, from supply and pricing to geopolitical risk premiums. Joining us now to tell us what he is watching is Hussein Aladina of TD Asset Management, and he joins us from Miami. Hussein, it's great to have you join us. Thanks so much.
Thanks for having me.
Listen, I just want to have a very open-ended question to start. You saw this happen in the weekend. You've had some time now to think about this and digest. What are you watching right now?
Yeah, so I think the kind of near-term impact of this is, if anything, slightly bullish. There's some production that has been impacted in Venezuela since the blockade began. For context, right? Venezuela produces today somewhere in the 900,000 to 1 million barrels per day range. There's a lot of discussion about the reserves that they have under the ground, but today they're producing 900 to 1 million. And I think that number has been reduced by probably 200,000 or 300,000 barrels a day following the blockade. It's unclear that that crude is going to be available in the immediate term. But this is in the context of a market that is oversupplied, and 2026 balances look pretty heavy, Kim. We've talked about this before. The idea that we're going to grow Venezuela's production and tap these resources and send these great American companies back in there is something that could come to fruition, but it's going to take a lot of time and a lot of money. So kind of near term, I think, if anything, it's slightly bullish, not meaningfully, because of that sort of oversupply that we're dealing with through at least the first half of 26.
You mentioned, it takes a lot of money, and I've heard others say there's a lot of things that have to go right in order for you to build the infrastructure to get the oil from Venezuela. How long do you think we're talking in terms of actually seeing a meaningful difference of production if it is to happen?
Yeah, so I think like in the near term, and I'll quantify that sort of the next 12 to 24 months, we can probably see Venezuela's production grow somewhere in the 200 to 500,000 barrel per day range. 500 might be a stretch. There's a lack of infrastructure in Venezuela, right? Following kind of Chavez's ascent and the Bolivarian revolution, which was late 90s, Venezuela's production has declined from 3 million barrels a day to sub-million barrels a day. And the infrastructure, I haven't been there, but the infrastructure I've heard is quite challenged. And the crude that's produced in Venezuela is similar to the crude that we produce in Canada. It requires diluent, it requires a tremendous amount of gas processing, a tremendous amount of upgrading before it can be used. So I think, optimistically, 2 to 500 on a 2-year view, and then to get back to 3 million barrels a day where they were in the late 70s or in the late 90s is probably going to require 50 to 100 billion dollars of investment, and 5 to 7 years if we're lucky. So I don't think it's impactful near term in any meaningful way.
What about, you mentioned Canadian oil, and Canadians, of course, we know we have heavy crude. They have heavy crude. I don't pretend to know how similar they are or dissimilar they are, but maybe you could shed some light, because a lot of people are saying, well, maybe the Canadian heavy crude that's going to refineries in Texas now, it's a lot closer to go from Maracaibo in Venezuela to Texas.
Yeah, so from a quality perspective, both Canada and Venezuela produce what we'll call sort of heavy oil. The crude that is produced in Venezuela is heavier. It's a sludgier, it's a dirtier sort of oil, requires more upgrading. But even outside of that, Kim, in order for us to get that crude from Maracaibo to the Gulf Coast, we have to build infrastructure in Venezuela to export, and we have to build infrastructure to get that crude from the Gulf Coast up to Pad 2, where a lot of the crude in the Midwest goes from Canada. So, I think this is a risk for Canada, and I think it should encourage us to build more infrastructure to open up markets. We've talked about this before, right? We shouldn't be relying on the U.S. alone. We should export to the rest of the world. But I don't think it's as easy as some of the commentary on FinTwit might suggest.
What have I not asked you that I should be asking you just to finish things off?
I think a lot of focus on what this means for Canada. The Canadian equity names, the energy equity names are down on kind of this news over the weekend. Let's just remember that it takes a very, very long time to build out infrastructure. Again, a lot of the expertise that existed in Venezuela to produce this crude left following the nationalization of PDVSA. Part of the reason Canadian production grew the way it did was because we had Venezuelan engineers who left Caracas and came to Fort Mac, slightly different weather. It takes time to build out that expertise, that infrastructure, that knowledge, that know-how. I don't think markets move quickly, but ultimately the crude production is not going to move as quick. So I don't think it's as material as some might be pretending for the crude balance in the near term. And we need these barrels longer term for sure. But near term, I don't think it's that much of a deal.
Hussein, always great to talk to you. Thanks so much.
Thanks, Kim, for having me.